So the idea was, how are we going to consistently have this flow of investors connecting with us? The decision we made, a lot of other groups, some other groups don't go down this route. We've seen some companies that have had tremendous growth here in Canada and the US, which didn't go this route and went, took different directions. But our idea was the educational route. So it's just being everywhere. And a lot of times, by the time people get on a call with us, they're like, hey, I've seen you here, I've seen you there, I've spoken to you. So that triad of know, like, and trust has already been built, and is a lot easier to say, all right, great, invest $100,000 with us. You're going to be a limited partner. You don't really have much say in this partnership. We're going to make all the decisions. There is a lot of trust needed for somebody as an investor to take that step. But the brand we've built, the know, like, and trust that we've built, makes that journey much more easier.
Hello, and welcome back to the Real Estate Effect Podcast, a show dedicated to real estate investing. And today I'm very excited to be speaking to August Biniaz from CPI Capital. How are you doing, August?
Great, man. What a pleasure to get to meet you in person first and then meet you online here. Usually it's the other way around. So I'm excited to be here and chatting with you.
Yeah, that's a really good point, because we've actually crossed paths a few times, and then we met in person at the MULTIFAMILY Real Estate Conference in Toronto a couple of weeks ago. And so here we are today.
Absolutely, man. Can't wait.
Yeah, so I'm really excited to have you on. You have a different model and you operate in a different way, and I'm really excited to share this with the audience. So you're the co-founder of CPI Capital, which is a private equity firm that invests primarily in real estate assets in the US. And so first of all, like, how in the world did you start this fund?
Oh yeah, no, I mean, excited to get into the journey and tell you a little bit about my background and start, because my background really builds up, the idea, where the idea came about, and how solving a problem really, it was at the center of it. My background started here in Vancouver as in real estate as a real estate agent 16, 17 years ago. I wasn't really good at being an agent, but I was good at finding deals, start doing small fix and flips. Started my own general contracting company, moved on from doing fix and flips to building single family homes, both spec and custom. Always wanted to scale. I had a project that came across my desk that I just couldn't walk away from. It was five single family homes. That was a land assembly that could build 20 townhomes on it. It was a contract that somebody was flipping to me, put it under contract, didn't have the equity to be able to get involved for buying the land, let alone the equity needed to construct it. But I went to a few investors, raised over $5 million, purchased this property. But the way I structured it was that, since I didn't have experience in building ground up development multifamily projects, I came on as an advisor. I found the deal. I brought on the investors. I brought on all the professionals, and we structured it in a way that I would get a portion of the profits relative to the performance of the asset. So I fell in love with that idea, rather than being a builder or developer or home builder. This idea of finding deals, finding investors, and getting a portion of the profits. Yeah. So I dedicated some of my time in understanding how to raise capital. How do large private equity firms that buy companies like the Blackstones, the KKRs, the Apollos of the world, how do they go about doing that? And I read a bunch of books, Barbarians at the Gate, King of Capital, the great books about the rise of Blackstone and Steve Schwarzman. So I wanted to merge the two worlds, the world of ground up development and private equity. And the more research I did into it, I realized that most of the content that I was getting was coming from the US, and that they had perfected the system. But the business model they used private equity for was not ground up development like I wanted to use. Most groups were buying already built apartment buildings, apartment communities, and they would do some small upgrades to these buildings, sell it in 3 to 5 years, give great return back to their investors, and be cash flowing from day one. So I'm like, okay, amazing. I want to, duplicate the exact same model here in Canada. I start calling some brokers, start looking at some multifamily deals, realize that they're not really cash flowing. The rent to value ratios, the rental yields are so low here in Canada that if you do a conventional mortgage on a 100-unit apartment building, if it's in Vancouver, Toronto, or any of the suburbs, you're in negative cash flows. And because of restrictive rent control laws, the business model to go in, do some upgrades, force appreciate the asset by increasing rents, increasing the NOI, and turning the tenants after their 1-year lease is over didn't really work here. So that was kind of the impetus in looking at the US and realizing by bringing these US investments to Canadians, we actually have a monopoly. But I'll let you ask some more questions before I keep going.
Well, no, but thank you, because you perfectly laid it down for me in terms of the springboard of, so you quickly realized that in Canada, the cash flow makes it very difficult to use that model. So you looked at the US market. Obviously, well, for a lot of us, we see the US as I don't want to say the land of cowboys, but like there's a lot more opportunities when it comes to deals like that. So kind of walk us through, like, okay, when you set your mind on doing that in the US, like how did you go about it, and where are you at now?
Yeah, just to add a couple of more points. So we, as far as a comparison with US and Canada, we discussed the rental yields. We discussed that the cap rates, the yields are different in the US. We discussed as far as regulations and rent control laws. So that's what sets apart Canada and the US. But you also got a much larger market. You got over 300 million people. You got a very entrepreneurial nation. You have an interstate migration that's taking place in the US. So where Vancouver and Toronto rely on international immigration, the US, they rely on in-migration, people moving from California and New York into these other states. So there is a movement taking place, and as long as you line up your chips correctly, you can basically hit the jackpot depending where you're looking. So looking at certain growth metrics. So that's what kind of piqued my interest in the US, and I really put my investor hat on, and I looked at deals. I'm like, if a project was brought to me from Canada and it was a multifamily or ground up development project, and those are the yields would be a certain way, and then I had a US deal that came to me, and there's cash flowing from day one. There are preferred returns. The exit is in 5 years, and the IRR, will blow out of the water any Canadian deal. Of course, I'm going to go with the US deal. But there was also other potential pain points is when Canadians are investing in the US, there's a potential of Canadian investors needing to deal with the IRS, need to file US taxes. So that's one hurdle we had to get through. And us, for a company, we had to kind of deal with the compliance side of things, raising capital in Canada and the US. So that's a bit more information about that point.
Yeah, no, totally. And you're absolutely right. Like going back over the numbers, the cap rates, Canada and US, there's quite a big gap, and the IRR, internal rate of return, is much greater in the US. And as you said, it's a very different market because it doesn't rely as much on the immigration side, but a lot more on domestic movements. Because on average, Americans are a lot more mobile than Canadians are, and it is twice the size, not twice, 10 times the size in terms of population.
10 times the size.
Yeah,
Exactly.
10 times. So when you went to the US, like what markets geographically did you first start to look at?
Geographically, we looked at, so there is a level of speculation that takes place in real estate. Everybody knows that. You buy a piece of property, but you do hope that someone is going to pay you more for it in the future. It's just how you're going to get there, right? And it's the past performance that's going to lower the risk or increase the odds of the property having natural market appreciation. So we looked at markets that show consistent growth, such as job growth, population growth, income growth, rent growth. And again, some of the markets are obvious. Obviously, Texas is a huge market. We own an asset in Houston. You've had a huge in-migration happening from California into Texas. A lot of Fortune 500 companies are moving there. Texas is expected to have another million of in-migration over the next 10 years.
Wow.
So Texas was on our radar. Florida, we have another asset in Florida. In North and South Carolina, we have an asset in Charleston, South Carolina, and these are the states really because of their lower cost of living because of their business-friendly laws. Most of these states don't even have state taxes, so a lot of people are moving to them, and really better weather as well, and not as expensive to buy real estate. So it's great places for people to move into.
Yeah, for sure. And those three states that you mentioned are quite known to be a lot more pro-business and welcoming for investors. So then your first, let's go over your first deal and your first purchase with the fund. Was that in Texas? Can you kind of walk us through it?
Our first purchase was that we bought was in Orlando, Florida. Okay. So it was a tremendous growing market. It was a large $92 million asset, 350 units, Class A asset, was recently built. It was over $30 million equity raise. But to take a step before that and to kind of pave the road for this conversation, when we started CPI Capital, the mandate was U.S. institutional multifamily assets to bring these types of investments for our investors, both Canadian LPs and US LPs. But a newer company that hasn't had a long enough track record, doesn't have access to that amount of equity, how are you going to bring those types of investments? And the reason we focused on the institutional multifamily asset was because they had shown the best performance over the last two, over the financial crisis, mortgage crisis in 2008, and the recent COVID, the situation. They had been resilient. So those are the types of assets we want to focus on. Also, when it comes to management, property management, most of these institutional asset, 100 plus doors, have third-party property manager. So it's a lot easier to manage these properties, and the risk is much, much lowered on these larger properties. So that was our mandate. The next step was for us how to achieve that. Great. So we do have, we have built a great brand. We've connected with many investors. How do we go about closing on these large deals? And that's when we explored this concept of co-syndication. So a syndication model, just to explain this broadly, is two groups coming together, a group doing the management and is basically the brains of the operation, and then the other group is funding the equity needed for the deal. They're as silent partners. Usually a limited partnership structure is used for a syndication. So a co-syndication is when two or multiple general partners come together to manage the property, to jointly raise the equity needed, to source the asset, to do the value add model. So that we decided to go with a co-syndication model and partner with another group in the US who acted as our boots on the ground. And that's how we were able to close on our first deal, which was a $92 million, and that's USD. So that was well over $100 million. But everybody talks about starting small. A lot of time people getting into multifamily, they start with a fourplex and move from there. Our first deal was, was a Goliath of a deal.
Yeah, clearly. And so I'm interested, how did you go about finding this co-GP to partner up with? Because from their point of view, I mean, you're from out of country, and so they must really rely on your ability to raise capital quickly, because otherwise, sorry to say, but like, what is it that you're bringing to the deal?
Yeah, no, absolutely. So that's why it's so important to build a brand. And a lot of times you read a lot of these, marketing books, and they talk about you have two products. One product is superior to the other, but the inferior product has a better marketing around it, and it does much more sales. So it wasn't that our product was, our company wasn't, it wasn't like our company wasn't a superior company. It was the fact that we didn't have the track record, but the brand, it was about branding. The brand we built, the content we had created, allowed us to connect with a lot of investors. As far as optics, when other groups looked at us, we seemed much larger than we actually were. So that helped us a lot. Also, as far as experience, our leadership team had combined 25 years of experience in real estate. So when we did partner with other group, we did also play a role in the management of the asset as well, in overseeing the property management and other values we could add to the investment and to the syndicated investment.
Mm-hmm. And so just to kind of stay on this first deal, which is rather impressive for a first one, to say the least, congratulations on that. Roughly, like how long did it take you to raise that 30 million with the partner, and kind of like how did you go about it?
Yeah, so it was usually these multifamily deals are from the day that the offer, the LOI is submitted to the closing is approximately 90 days, sometimes shorter, but in reality there's 60 days of for capital raising. So the total capital, which was well over 30 million, I think it was close to 33 million, was raised in 60 days, and it was all from retail investors and no dealing reps or exam market dealers, or as they're known in the US, broker dealers were used to raise the equity. So it all came from accredited investors that were direct connections of the general partners.
Okay. Wow, so that's quite an impressive. That's quite the raise that you did in 60 days there.
Exactly. Yes.
So then you were able to close this one, or roughly around when was it? You said it was the beginning of COVID.
This was smack in middle of COVID. So it was in 2021. So it was in, I believe it was in August last year.
Okay, so just a little over a year ago, and then from there, okay, wait, just to stick to that deal. So then you were able to raise the capital, you closed on it, and then your agreement with the co-GP was that you would raise the capital. Do you have any involvement now in the operation, or are they the local boots?
Yeah, so we do have involvement in the operations, and now the way that one of the guidelines that the Securities and Exchange Commissions in the U.S. has, that when these general partners come together to do jointly do deals, a general partner can't only be capital raising, because now you're in the business of raising capital. So the general partners all have to play an acting role in the project. So we're doing site visits. We have to be at multiple meetings every month discussing information with property management and other groups, and all the meetings are recorded. So we go through a vigorous record keeping process to ensure that our involvement in the project and adding value to the project's growth. And when multiple teams come together, they can actually enhance the business model for better ideas, because they're all bringing their own ideas and their own backgrounds. So yes, we have hands-on involvement in the project.
Okay, yeah, that's really good, and it's extremely valuable experience going into the next deal when you're involved into this one. Like, yes, you've been able to raise the capital and closed it, but then you're involved, and it adds another tool to your tool belt and going to the next one. So after that, you said, was it South Carolina, or was it
South
in
Carolina.
Texas?
Our
Okay.
next deal was in South Carolina, in Charleston.
Oh yeah, Charleston. Okay. And so kind of roughly, what was the structure on this one?
This was again a very similar deal. It was a newer asset that was built. It was again an A-class asset, so it was a 2019 built, and we purchased it right from the developer. It was, I believe, it was just over $80 million asset. It was a 26 million dollar equity raise. We partnered with the same general partnership team, with the same operator, to buy that asset. And again, the same process, the same structure. We utilize a fund of fund model. So we create a Canadian fund. Our Canadian investors invest into the Canadian fund. Our partners and jointly with us create a US fund, and the Canadian fund invests into the US fund, just alongside the other US limited partners.
Okay. Okay. And then that was again in end of 2021, beginning of 2022.
That was end of 2021. That's right. That was in the Q4 of 2021.
Okay. And then so same time frame, like that raise was within the 60 days.
Exactly.
Okay. So then you said you moved on to a Texas deal.
We moved on to Texas. We did a deal in Houston, Texas. It was a smaller deal. And that deal closed beginning of this year, Q1 of 2022. It was just over a $30 million deal. It was a Class B asset. So it was a built year 2000. It hadn't had any updates. We're going in there and updating all the kitchens and bathrooms, spending between $5,000 to $7,000 per unit. And Fort's appreciating the asset close to $9 million. And I can go over the value add model, which I believe is the eighth wonder of the world, and I can go over it.
Sure.
Yeah, so value add. So I mean, this what makes multifamily investing so exciting is the value add play, where the business model, where by purchasing an asset where there is a value add potential, and value add meaning that you could go in and do some form of enhancement, either through renovation, either through better management, either through turning the tenants and increasing the net operating income. So, and in turn, increasing the asset's value. So, multifamily assets, multifamily properties are actually assessed by their income, not by comparables. It's from the income approach, not the comparable approach. In single family and smaller multifamily, it's really the comparable. Yeah. In multifamily, when a price when buyers or sellers are looking at the price, there's two numbers they're really looking at. They're looking at the NOI, the net operating income, and they're looking at the prevailing cap rate, the neighborhood cap rate. And those two numbers allows them to know what the asset's value is. So it's really by the NOI. So as long as you can go into a purchase an asset and do like I was mentioning about our Texas deal, we're spending between $5,000 and $7,000 per unit. Now that $5,000 to $7,000 per unit, over 232 units is approximately $1.5 million to $2 million in construction cost. But the weighting increases the rents and increases the rents by $150 to $200 per unit. And if you multiply $150 or let's say $200 times 232 units times 12, and the number you get, you add that to the NOI, and that increase in the NOI actually increases our asset by $9 million. Mm-hmm. So that's the beauty about really multifamily investing, and why it's been a hedge against inflation, and why so many institutions such as pension funds, such as REITs, invest in these assets. They're just such a safe place to park your money, and they've proven that historically.
Yeah, I love how you described it, because that's also exactly what we do. It's just on much smaller deals. And right now we're doing some renovations on a 4-unit. We just finished a 5-unit. We're in the process of starting the development and the construction for 17 with mixed commercial and residential. And it's also my goal to now go into larger projects and get a little bit more on the hands off from the operation and the renovation and so on. And I love how you described it. Like, people say, "Oh, start small with a 4-plex," and you started with a $90 million property. I mean, that's gutsy, man.
That's right. That's right. I mean, we sat down initially and we were looking at what is a company we want to build. Mm-hmm. Do we want to be, kind of build our way up, or do we want to build a real estate private equity firm that focuses on these types of assets? And since that was our plan, that's what we focused on, and we did not deviate from the plan at hand.
Yeah. So I'd like to take in the last couple of minutes to kind of focus on, you've achieved some tremendous growth. And as you said, you sat down, you built a really good recognizable brand, and you went after some large deals. I mean, on the other end of the spectrum, it's guys like me who really do start with like multiple 4-plexes and like slowly creep their way up. In your opinion, what made you so successful in doing that? Because the capital raising process is not an easy thing.
Absolutely. Really, it was the decision we made early on is, okay, great. If I go to my friends, family, business associates, people I've made millions of dollars over the years as being a contractor, being a builder, the connections I've made, great. I can tap into them, raise some capital to purchase our first asset. But soon we realized that we need a machine that's going to be continuously connecting us with investors. And we explored the exempt market route of connecting with capital brokers in Canada. They're known as exempt market dealers or dealing reps. In the US is broker dealers or equity brokers. We explored that and we realized the cost of capital is very high, and that will kind of erode the investor returns. So the idea was, how are we going to consistently have this flow of investors connecting with us? Mm-hmm. The decision we made, a lot of other groups, some other groups don't go down this route. We've seen some companies that have had tremendous growth here in Canada and the US, which didn't go this route and went, took different directions. But our idea was the educational route. let's create a lot of educational content. Let's become thought leaders in this space. So when people are researching information such as Canadians investing in US multifamily, a simple Google search that we come up.
Yeah.
So we started our own YouTube show, podcast, bring in expert guests on our YouTube. We're going to have you on our YouTube show pretty soon here. So bring in expert guests on our YouTube show, interviewing them, creating a lot of content, being very active on LinkedIn, creating a lot of content on LinkedIn, speaking other people's platforms like I'm doing today, speaking on summits. Our CEO authored a book, connecting with a lot of different platforms, such as in Canada here, RAIN, in the US, Multifamily Investor Nation, hosting meetup groups, basically eating, breathing, living, the space. And we talked about meeting at a multifamily conference, and before the show we were talking about the ROI and of the event, and I was like, you know what, just the fact that we want to immerse ourselves in the space. So it's not only focusing on the ROI of an event, but it's also just being involved. If there's a multifamily event taking place in Canada, we're going to be there. Yeah. So that's the direction we took. Also write a newsletter, weekly newsletter that is published on LinkedIn, which has picked up a great following. So again, creating a lot of content, being thought leaders, building a great brand, associate ourselves with the right groups and individuals, and as people, most people do a Google search, or they join different mentorship programs, or join different real estate masterminds, or informational real estate groups, and for us to be part of there. For example, RAIN Canada, we're a trusted partner with RAIN. So it's just being everywhere. And a lot of times, by the time people get on a call with us, they're like, hey, I've seen you here, I've seen you there, I've spoken to you. So that triad of know, like, and trust has already been built, and is a lot easier to say, all right, great, invest $100,000 with us. You're going to be a limited partner. You don't really have much say in this partnership. We're going to make all the decisions. There is a lot of trust needed for somebody as an investor to take that step. But the brand we've built, the know, like, and trust that we've built, makes that journey much more easier.
Yeah, much more easier. And as you said, like, to put a lot of content out there on educational, and to share what is it that you're working on, what is it that you're doing, how can people benefit from it. And I just want to share a little story. Like, sometimes people think it's easy, and I've shared this story with a friend, but not really on the air, where on a deal that we closed at the end of 2021, I was going to go with a private lender. And then someone had told me, like, hey, I'd be interested in doing a deal with you and this and that. And I picked up the phone and I called them, and that person got on board and essentially, like, wrote us a note for $300K for a year and a half at a very good interest rate. And that was a 10-minute phone call. And my friend was like, oh my God, this is amazing. It's like, yeah, but to make that 10-minute phone call took me 3 years to build that relationship. And so going back to what you just said of, you have to put some content out there so people can slowly get used to it. So as you said, by the time you get on the phone with them, they're warm, they're sold, they're just eager to be a part of it.
Exactly. One more thing that I can add value to your audience is also, it's not only about creating content and connecting with potential investors, is keeping in touch. And we call that the nurture process, right? Yeah. So you cultivate and then you nurture. So you cultivate through the content you create. People connect with you to come into your funnel, and now that you've connected with them, you've been on a phone call with them, and as you know, in real estate, particularly if people are not using the fund model, they might not have a current deal that investors can invest in. So you've had a great conversation with an investor, they've seen your content, you achieved that very important step, but a lot of people fail in the nurture process. They don't reach back out because they're either, conservative, or they're shy. They don't want to, they're like, hey, I closed the deal. This person is going to invest with me. And then 6 months later, they give them a call. The investor doesn't remember who they are, right? Exactly. So it's important to have that nurture process, and through the nurture process to continuously add value. It's important to use a CRM. We use a CRM called HubSpot. There's also a CRM called Active Campaign. Mm-hmm. They're both very decent. There's MailChimp and stuff like that, but I advise I would suggest HubSpot or ActiveCampaign as a CRM. Even if you're smaller, even if you're doing a fourplex, if you have only a handful of investors, still use a CRM. Allows you such great capability to keep in touch with your potential investors and current investors, and keep adding value to them. Get on a call with them once in a while and send them some educational information, some updates. And I would even suggest, if you looked at a deal, the deal didn't pencil out, and you, for whatever reason, it didn't work out, or you couldn't get to the best and final, is go ahead and let them know about that. Hey, I know we talked about a deal a while back. This is the most recent deal we looked at. We didn't get a chance to close on it, but just wanted to update you on that we're actively looking at deal, and I look forward to partnering with you in the future.
Mm-hmm. No, that's a very good point. And so many people only want to let and share kind of the good news. And sometimes, and we both know it, like you go through a bunch of due diligence, and sometimes you drop half or three quarters, and you have to let people know because it also shows that you have some strict criteria, and you're not going to go and invest their money into anything that comes across your desk. So it shows how rigorous your process is.
Absolutely. Like, for example, in our situation, we've slowed down the acquisition for a bit, sitting on the sidelines right now because of the rising interest rate environment that we find ourselves in. But the great thing, in the US, you can purchase rate caps for any increase in rates. There's a insurance that you pay for, but as long as the numbers pencil out in your deal, then it makes sense to go ahead with it. So yeah, that's where we're at. We're really looking at the market very closely, and underwriting many deals, but we're not super excited to purchase the next deal just because we want to do a deal. It's important that the brand that we've built to stay conservative and risk averse.
Mm-hmm. Absolutely. All right, man. That's been super interesting. Thank you very much for sharing all this. If people listening are interested, where can they find out more about you?
Absolutely. You can visit our website, cpicapital.ca. I'm very active on LinkedIn. August, like the month, August Biniaz, Biniaz. Send me a connection request on LinkedIn, and let me know you saw me on this show, and I'll be more than happy to book a 15-minute call with you if you like to learn more and build your business and you had some questions for me. Also, if you're looking to invest or other types of collaborations, just reach out to me. Make sure you mention you met me on this show, so we know where the connection came from.
Perfect. Well, August, thank you very much. It's been a real pleasure having you. And for everyone listening, as usual, thank you to keep supporting us. Share this episode with a friend who you think could benefit from this conversation. Send us some feedback, some comments, and I'll try to respond to absolutely everything that we get. So thank you very much. Keep listening. And until next week, stay active, research your market, and make some offers. Thank you very much, August.
Thank you.